General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
Okay, so we're starting off the third quarter. And what is my transformation as a trader this quarter? Which frameworks? Identity traits and decision skills am I upgrading? Trade weekly candle expansions, keep doing that. Going to aim for high probability trades, 2-to-1 risk reward or 3-to-1 risk reward. Framework selection, one shot, one kill is my A+ setup. Equity growth plan, the outcome of a single trade does not matter. What matters most is that our equity management align with our monthly projections. And this is just the IE part. Risk tier logic, no more than 8% a month of risk allocation of total capital per month. This risk allocation will be broken down into risk profiles, one shot, one kill, 2%. One shot, one kill, conservative, 1%. Then add 1% in day trade, 1%. Bread and butter or counter trend is a 0.5%. Risk management standard of procedure. If we exceed the risk allocation of 2%, we automatically have to stop and withdraw from trading for a week. And then that's the SOPs. KPI targets 18 and 24% for the quarter is the quarterly objective. Okay, we look at the seasonality going into. We just had this little middle of the year rebalance that we have every year. It's not the end of the world. We're setting up July, August, September. So July is supposed to be easy money, and then August, September, we get to the end of September. That's going to be our next quiet witching. So you can see the quiet witchings. March is not one. It's not like a big drop, but this June and then September are the big quiet witching drops, which line up with options expiry. Okay, forecast for the quarter. Looking at 32, bullish. Everything's just bullish right now. Got this compression, got this expansion. Kind of doing a retracement right now. This monthly fair value gap does sit at 50% off. Could attract a lot of buyers. Even looking at this is March low, thinking that's the low of the year. Story price. It's more this. Distorted price framework alignments, basic midterms in Iran. So for SPX, got 78.77 for the quarter objective. Previous month's low looks reachable now that we crossed over previous month's EQ. Yeah, some NASDAQ March, same low. Nvidia's a little different. I still think we're bullish on this. 260 is a good target. This is the heaviest weight in stock, so while it's going down, the market should be going down. We got some equal lows here. It's kind of far. I don't know if we're gonna get that for the quarter. I'm still leaning on bullish side. Seeing as that seasonality chart, the buy should pick in now, and it should be the seasonal pullback. Kind of in the range, yeah. We left this old range. I doubt we get back over here. Just could be rebalancing for the middle of the year. And this is the April. April created this low for this year. Really, it's here. Nvidia already sold off. No, Nvidia already sold out for next year, and everything progressing in the market is somehow tied to Nvidia chips. Yeah, so they sold out their inventory already for next year. It's risk on, risk off for the quarter. It's the monthly chart. We had this monthly expansion. Crazy chop. We traded all through all this. Then we dropped down. This is like the real big risk off. It's probably Trump. Now we pushing up. A lot of it is GDP and war. We could have a regime change with the new Fed chair, so we got to keep our eye on Kevin Warsh. Take a look at the bonds. Bonds look like they're going down. Reacted and respected off this monthly order block. Could start buying back here. So we got dollar going up and bonds basically going down. So the stock market should go down, but we still looking at seasonality and everything. So it could just be the pause before the turnaround. So you see, boom, boom. This is the seasonality. We already looked at this. With the regime set frame weekly, we were waiting for the market to build a base and start looking for buying opportunities. We're still bullish. Here's the July environment. Powerful rally phase begins. Decennial and cycle alignment. NQ expansion returns. Pullbacks get bought. SPY. Trend persistence improves. My focus: increase sides gradually. Favor continuation over fading and let winners run. I'm thankful for this month. Here we go. Some monthly fair value gap. We was just looking at lines up with 50% of this dealing range. Pretty much fair value too. The bias is bullish. Mid-year rebalancing. Iran conflict situated from the market's perspective. So even though the general public, I have all kind of things about the Iran conflict, the market then situated what it thinks of it. It's a midterm year as well. Looks like we're accumulating in this high. So I'm thinking maybe like an AMD. So accumulation, manipulation down, distribution up. Similar here. It's not really too big of a difference. Nvidia is a little different. It's the weekly. Okay. Bias here is neutral. Yeah. They reported the best earnings and forecast ever, but we still in this old compression range. True. But look at AMD. So we should see some up off with Nvidia. They're probably just getting into a nice little fair value. And when you break this candle down like to a weekly or a daily, you can see that wick is probably like some major selling. AMD is going crazy. I think they said they're going back to CPUs, so that left a long part But the chip market, AMD is soaking up because NVIDIA is focused on GPU, so it's the letter difference GPU, CPU. 6 to 8% a month is the goal. Focus, no more trying to get in early on the reversal, let the move show itself. Study theme is myself. It's a good study theme. All right. Week one. This week, Italian bank holiday. ECB president speaks. Tuesday, we got jokes. Wednesday, we got Wash at 9 a.m. and PMI at 10. Wash is going to be interesting. And Thursday, average hourly earnings, non-farm employment. And Friday is 4th of July Eve. So U.S. market reacts to Trader Moon strikes today. May jokes job openings Tuesday. June CPU consumer confidence Tuesday. I can see on manufacturing Wednesday. Jobs Thursday. So interesting. All right, for the S&P consolidated, we got a lot of profit taking. So a lot of profit taking on shorts over here. Commercials took a lot of profit taking on long and shorts. Nobody's adding positions. What? Okay, so this is the first time I've seen that. Okay, so we got 72% of the long open interest taking profits. That'll bring the market down. A little bit more short than long. Yeah, it's very interesting. All right, go here. Small traders bullish, commercials are bearish, large specs are bearish. This alignment is unusual because retail traders on the opposite side of both institutional groups. Yeah, active institutional traders are net short over 120,000 contracts. This is meaningful. Yeah, that is meaningful. Using commercials are not buying aggressively. Large specs are also selling. Retail is heavy buying. This combination usually does not favor an immediate sustained rally. It's increased volatility, failure rallies, downward bias, potential downside breakout if price loses support. Least likely is a strong upward trend immediately. Makes sense. This is not one of Larry's classic buy the commercial setups. No, okay, so it's not commercial strength. Commercials are actually selling, not absorbing supply, not showing accumulation. Large specs, small traders, commercials are bearish, large specs bearish, small traders bullish. Because commercials are not accumulating, any seasonal strength will be viewed as a rally to monitor rather than chase. An opportunity to watch for exhaustion if price reaches resistance. So we gotta really watch those bearish swing blocks. There's a cautious stance with moderate or modest downside bias. Let's look at NASDAQ. This one contract difference is due to rounding. Okay. So unlike S&P, NASDAQ is a little bit more bullish. Compared with S&P report, commercials have gone by. Large specs remain bearish. Retail tends to be bullish. This often creates a market characterized by choppy consolidation, increased volatility, and short covering rallies. Potential upside breakout if price confirms with technical strength. Okay, so it's not as bearish, which makes sense because they're getting SpaceX and the Nasdaq. Here's this commercials have started accumulating, but the position is not yet strong enough to indicate a classic major buy setup. Okay. Media bias is neutral to mildly bullish. This is opposite of spot for late June, early July. Early summer strength will support the possibility of upside moves. The price confirmed for breaking. Yeah. Okay. So they're selling SPX and they're getting into tech, which makes sense. And I did oil. Oil is super bullish. And the commercials are basically the people that produce it, so it's a little different. Commercial, yeah, swap dealers, reportables. Yeah. The traders are bearish and commercials are bullish. It makes sense though. So here for the CB Fed watch, 30% chance of a hike, that's bearish. Usually the ease sentiment gives us bullish price action. The height sentiment gives us bearish. Nothing for actors. General Mills and Nike. Over here, we're leaning a little bit more bullish on the sentiment. So the count report came out after the sentiment. S&P was bearish. Probably still more bullish though overall. Now today's here. Got this move coming from this daily order block. Maybe compare orders here. It does make sense to me. Hit this 20-day low. You don't have to because we're kind of in this block. Pricing out for a daily OP, looking for fair value for buying. Okay. SPX selling out from this daily order block. First contact here. Daily bullish order block. Let's see if we can turn around. I like the wick rejection. Push down for no reaction, but we make the first contact at this bullish OP. We'll see if price wants to break it and go lower. Now for here, coming off this weekly level, selling off to the 200. We're also about 2026 open. This right here is the best possible price for me, just because it rebalances everything. Looks like profit taking after last earnings. Also, we're approaching the 200. That's a big level, and we should track buys. As for now, it's too early to buy. Let the move show its hand, then grab it. You know, and it's still the best story in the U.S. market. Skill focus, more intentional daily range following. Journaling tip, stay on top of the log. Case study hunt plan, look for fair value. Weekly risk block, 1%. This week one, new quarter, no rush. Plans trade day Tuesday. Looking for the Joe's jobs numbers to give a heads up to Friday's jobs. Well, not Friday's, Thursday's jobs numbers. Or it could be Friday and just the market closed. Either way, it's NFP week. Yeah, and Tuesday. Heck, that's down there. Yeah,